everyone, Matt McKeever here, and I've got Ehren from the Findlay Mortgage Team with me. Hey, Ehren, how's it going?
I'm good, Matt. How are you, buddy?
I'm doing well. So today we're going live talking about Canadian mortgages, what's going on in the real estate market. If you guys have any questions, feel free to jump in the chat, hit us up. Ehren's more than happy to answer any of your questions, though, if the question's how can I buy a house with literally $0 and zero effort, there's no one mortgage product that's going to just solve that issue for you. But if you guys have been watching recently, some of the videos we've been covering, we've been talking about small commercial properties, right? We've been talking about some of the changing rules around mortgages as well. So we've seen some slight changes, right? CMHC recently changed their whole process because they were losing market share. That in and of itself is fascinating. But I guess, Ehren, when thinking about the first half of the year and what was going on from a real estate and mortgages perspective, what do you think people would need to know in case they were maybe just in a COVID coma for the last 6 months?
Yeah, I think, first thing is the market is flooded with investors. It's competitive out there. Just as competitive as it probably was mid to late last of 2020 as well too. We never really saw the market cool down at all. Stayed hot in through late into the fall over like that winter time area as well too. Stayed hot, and right at the beginning of 2021, there wasn't really a dip where usually you get a little bit of a lull in the real estate world. We didn't really notice that this year. So market is just as competitive. May not be seeing as many offers as you've seen in the past, but in terms of investors in the market and the amount of people looking at deals, it's still pretty competitive. So,
and I guess talking about the competitive nature of the market these days, Ehren, from a financing perspective, everyone wants to be able to go in with a clean offer, but sometimes we can't do that clean offer because we do need financing in order to be able to execute on the deal. What are some tips or tricks that we can do in order to really set ourselves up for success when thinking about wanting to put in a mortgage condition, right? There's probably some front end work we can do rather than just wait until we get the accepted offer and then send you all the information.
Yeah, no, I agree. The age old question of can I go firm? Every deal that comes up, and we understand. We know what the market's like. We're not going to be pretend like we're ignorant to the market and how competitive it is. And we understand there's a lot of other people putting firm cash offers out there, and you guys got to stay competitive. So we understand that. From our end, our best tool is just being as prepared as possible and making sure our buyers are as prepared as possible. So if you're a new buyer and you're looking to get in and this is your first rental property, book some time with us. Let's set aside 30 minutes or an hour. We'll go over your portfolio or your financial situation. What does your income look like? How much borrowing power do you have? Do you have the capacity to buy it on the A side? Do you have the capacity to get it on the B side? Maybe it's a small commercial product that we've talked a lot about, or maybe it's a private acquisition, but having as much due diligence done up front is going to put you in the best position to be able to go firm. And I think that's where the disconnect between a lot of the buyers is they think it's the mortgage broker's job to tell them to go firm, when really it's our job to be able to just make you as informed and do as much upfront due diligence to put you in a position that makes you feel comfortable, like you can go firm. If you're looking at a property and you have no idea, can I afford this? Like, am I looking at an A option or a B option? Is this going to be private? You haven't done your due diligence, and you should be working with a mortgage professional who has already laid out your pathway saying, hey, if it's in this purchase price, you're good to go with an A lender. Anything above this, you're going to be looking at 20% down with a B side. If the property is in this shape, or, if you're looking to do with this property, it's going to be a private lender. If you're looking at a multi-unit and it's tenanted and it's turnkey, we can get this done on a small commercial. Here's where that rent should be. And you should have a really good idea and know what you're looking for, not just out there sorting through private off-market deals and the MLS saying, I think I like this one, and it's way outside your price range. And if that's you, you haven't done your due diligence and your mortgage broker hasn't done their due diligence for you, and you should be 98% ready to go. And that last 2% is plugging and playing some of the variable numbers that we don't know about ahead of time. Property taxes, we kind of guess, depending on where the property is, we can estimate how much market rent you might be able to use, but that last couple percent there should be able to be filled in once we get the MLS, an idea of, or at least know where the property is going to be in, for these off-market properties, if there is no MLS and there's no pictures there, is there a buyer's package available from the seller? The more documents and the more prepped we can be, especially with the off-market stuff and how tight some of these A lenders have been. Just because a property looks great from the outside, how does the interior look? Do you want to wait till you're halfway through the process and you've gotten your appraisal back to know what it looks like? And from our end, if we take a look at some pictures, we can tell pretty quickly if this is going to be able to get done with a conventional lender or if you're going to be looking at some sort of private acquisition on the purchase. Yeah,
really appreciate that perspective. And I guess when we're talking about going with private lenders, let's maybe explore that a little bit further. And, everyone wants a hard answer, right? Like they just want to give me a rule so I can abide by this rule. And obviously each private lender and even just B lenders, they've got their own criteria. But as a general rule of thumb, Ehren, when someone's looking at maybe using private or B lenders, what's the typical turnaround time they can kind of expect or they should budget for when asking for those conditions?
Yeah, so that B lender or that Schedule II bank, and just so everybody understands, when we talk about B lenders, we aren't talking about private lenders. We're talking about Schedule II conventional residential lenders. So it's going to be the same timeline as a conventional type purchase on the A side. 4 weeks is an ideal turnaround time. 15-day closes. Can you do them? Sure. Is it ideal? It's definitely not ideal. You better have all your ducks in a row.
Yeah, and taking a step back there, Ehren, just even on the condition period side of things.
Yeah, definitely. So financing conditions, 5 days to be safe, 5 business days to make sure that we.
And those business days are important, right? Like, yes, I know we're coming up on a civic holiday. Understand, guys, bankers will take every holiday offered to them always. So we need to factor that in. And it can actually make a real difference when you're writing that offer. If you're smart enough to put 5 business days, that looks way less intimidating than saying 8 or 9 days if you're trying to squeeze in, a holiday weekend and you've got 2 weekends and all that. From just the layman's perspective, looking at that contract, if I see 5 business days or 10 days, I'm going to almost always assume that 5 business days is shorter, even though it may end up being the exact same amount of time. So it's also important to think through how we frame that. But yeah, it's just really important that you don't accidentally hamstring yourself. Because if you said 5 days and it's Friday right now, well, Saturday, Sunday, maybe a holiday Monday's in there, and all of a sudden now you're just giving Ehren 2 days to try and figure this out.
No, definitely. And like you said, in a world full of clean offers and competitiveness, being wordy and being sophisticated in the way that you write, it is important. And we had talked to Sean Quigg at Carson Law about this a few times. And having a lawyer who understands lawyerese and how to verbiage and how to write specific conditions in there, can be just as important, because sometimes you can word things differently and it doesn't look as restrictive as a condition as asking for a period of financing. Because when you ask for that period of financing, it really just sounds like you don't have your finances together, right? It kind of seems like you haven't gone to a mortgage broker, you don't know where you're at, and it just seems less enticing. And there's other ways to write that, and maybe using a due diligence clause, that comes off a little bit different than asking for a 5-day condition for financing period. So working with, either a realtor and a lawyer who know how to, use those legal terms and that verbiage can be super important. And like you said, business days versus days is a huge thing. Knowing your calendar, like you said, with the holiday coming up and you got a 3-day weekend, and on a Friday when half the day the underwriters aren't working, you basically wasted 4 days. So hopefully they can flip that around in 1 day. So the 5 days is really all you should need. Lenders understand when there's conditions of financing, and they do put precedent on those deals. And a good mortgage broker is going to have a good connection with their business development manager and the underwriters at that bank, and hey, follow up with them with the next day and making sure that commitment gets back. And honestly, typically lenders are pretty good at getting back to us within 3 days. But it's a busy market out there. The 2 extra business days just helps to give the underwriter some time, especially if you're submitting into a more popular lender. Like Scotia is notoriously slow right now. Refinances are being pushed. Purchases, there's some very specific conditions you have to meet for it to be considered rush. So just understanding who you want as a lender, and your entire submission as a whole picture is important to understand the timelining with that. Now, touching on condition of financing, if you are looking at a small commercial type product and you're going on the small commercial side, understand that you aren't going to get a commitment until after the appraisal has been conducted and received back, and the entire package has been submitted into the credit analysis team. So, if you're looking at a duplex or a triplex, we can probably get that appraisal turned around in a pretty similar time. So, maybe from the time that you reach out to the appraiser, maybe they book it for the next week, you get it back at the end of the day, end of the week. So you're maybe looking at, 10 business days. Give the lender 5 days to submit that into their credit analysis team. So you're really looking at 3 weeks before you're actually going to receive a physical loan agreement or a commitment. So it's a little backwards, whereas on the residential side, after those 3 days, you get a commitment. That's a conditional commitment, but you still receive it. On the small commercial side, you're going to get an LOI, which isn't worth a whole lot in the grand scheme.
No, it really isn't. And it's important you realize that as an investor. Absolutely.
Yeah. Just because you get an LOI doesn't mean that you're going to get financing on your building. I mean, it just means that the lender is interested in the building. It's in an area they lend in. The loan amount seems like it fits their general underwriting. The loan to value is where it's going to be at. You're going to get a generalized rate. Other than that, it's really just an idea for the borrower to know where this is going to come in and around, and it can change. We've had loan to values or letter of intents that show up in 75% loan to value, great, and then by the time you get the appraisal, you submit the whole package in. The credit analysis team comes back and they're like, "Yeah, no, we actually are like 65% on this," and it's everything is conditional in the financing world. You get a commitment from a residential lender. That's conditional. They have the right to pull out up until the day of funding if they don't like something. Same on the small commercial side. It just takes a little bit longer to get that commitment. So I'm dealing with this actually right now. Clients reached out. They had a sixplex in the Kingston area they're taking a look at, and they had 10 days of financing. And it's just not going to be enough to be able to get an appraiser out there, get the appraisal done. Depending on the loan amount too, some lenders with a minimum of $1 million automatically request a phase one. So, to be able to get that phase one done can be 4 weeks sometimes. So, just understanding the timeline of that small commercial, and it takes some understanding from the seller standpoint as well too, depending on the building. And an experienced seller will know that, but maybe a newer seller on the market may not understand the whole timeline. So.
Yeah, really appreciate you breaking that down for us. And we've actually got a couple questions from the audience. So I'm going to jump into the first one here. So, hey, Matt and Aaron, as an aspiring broker, how to secure a mortgage of $200,000 to $300,000 if I'm currently on benefit and averaged about $15,000 a year in income? A B lender, I'm assuming. So I'm assuming he means as an aspiring investor. As an aspiring investor, if someone's looking to try and qualify for a mortgage for $200,000 to $300,000, they've only had $15,000 a year in income. What sorts of options are out there? I'm going to guess that this isn't going to end up being a 0% down sort of deal.
Yeah, it's if you're aspiring, obviously, my understanding would be that you don't have a portfolio to leverage for any collateral equity.
But let's explore that just for a second, because oftentimes that is an opportunity for existing investors that they overlook. Yeah.
So, and this is a good opportunity. 100% financing. It gets thrown around a lot. And I mean, there's really two ways that you could potentially achieve some sort of 100% financing. And the first and the best way is have collateral equity and be able to use that equity to securitize a private mortgage and allow the lender to feel a little more safe in going, whether it's 95, 98, 100%, 100% being the ideal, but securitizing that loan with the security of the collateral equity. What that does when you collateralize a piece of property that has equity, it gives the lender the ability to essentially have access to that equity in your other property in case you default on your mortgage. So, if you're looking to borrow $100,000 for your down payment and you have a property that, let's just say, is free and clear, and you collateralize that property, and the lender is going to give you that additional loan to value up to 100% in the form of a collateralized mortgage. So what they're going to do is, 20% down, so it's a $500,000 property. They're going to register 500,000 on your subject property that you're purchasing. They're also going to register that 500,000 on your collateralized property. And what that does is, if you default on your mortgage, the lender has to take that property and go power of sale. By the time they list that property on the market, it sits on the market, it depreciates in value. The likelihood of them getting that full face value back to the property decreases. So they offset that risk by putting a collateral charge on your other property, so that any equity they lose from the loan amount, so if they sell that property for 400,000, they can take that 100,000 extra out of your other property and recoup. So that's where that risk of having 100% financing with collateralization comes in, because that means you have to be able to give up that equity in that other property. Now, they understand going power sale in your other property may not be the best idea. They may allow you to find some other way to liquidate a car or assets to make that up, because it's a long process. But in the worst case situation, it means selling your other property and leveraging that equity to be able to give back, or finding a way to utilize that equity. So understanding the risks. The other way can be with buying an undervalued property and using a purchase based off of the appraised value of the property. Now, it can be hit and miss with this, and you guys got to understand, like, depending on who the lender is and what type of property it is, you're going to have mixed results with this.
Yeah. So I think the first thing, because I understand the hesitation, Stephen wants to go too deep into this, Ehren. So first things first, guys, there's no guarantees when we're talking about the strategy he's about to go into, but I think it is very valuable for you guys to be aware of. So I would like Ehren to highlight it here for us. So Ehren, maybe let's first talk through like a deal where you've seen someone actually do this, just high level, so that we can kind of set the expectations.
Yeah. I think one that a lot of people have actually seen is Sid and Ishan's deal that they did in Cambridge. I know they've talked a lot about that, and it was a pretty cool deal where, I think they were able to get a full 100% loan to value on that mortgage. But basically, they bought that property, had a huge potential on the ARV, and the lender who put that mortgage on there was super familiar with the area, was very comfortable knowing that property was going to come in a lot higher, and felt comfortable putting that loan to value on the property on the purchase. So when you're looking at using 100% financing based off of an undervalued property or a higher appraised value, you're usually looking at some sort of independent private hard money lender, not like a mortgage investment company, but a mom and pop, just someone who's got some wealth and is looking to put it out. The institutional private lenders, aren't going to play that game of, hey, I bought this property for here, but I got this appraisal and it's telling me this much, because from an institutional standpoint, they look at the property value being what two people agreed upon on the purchase. If you're buying it for $250 and you have an appraisal for $350,000, why isn't the seller selling it to you for $350,000? Why is he realizing that $100,000 loss? So the institutional side is a lot trickier to get this done with. So which means you're going to be trading, that better rate and that more competitive term for that true hard money lender who maybe has a great understanding of the area and, is able to take on that risk a little bit more than a mortgage investment company who has shareholders that, he's going to have to answer to if something went sour and he went 100%. So it is possible. There are deals out there that happens. It's just understanding which type of lender it's going to be. It's not going to be the most competitive rate in the competitive term, and making sure you give your broker enough time to be able to get the deal done.
This is kind of a unique situation, unique deal. Usually the moment the word unique comes up, I think it's important we add time to the formula or the equation there to actually give it a chance. So we talked earlier that, when dealing with just kind of your traditional A lender, 5 business days isn't a bad target to aim for condition period. If we're looking at maybe one of these more innovative products where we really do believe that we're buying the property significantly under the fair market value, what sort of time for conditions should we be putting in?
That 5-day period is probably still good. You could probably even go 3 days if you really, and again, like having the initial conversation with your broker and understanding where you're going to be at. We work with some independent private lenders who are able to, we have their personal phone numbers. We have a personal relationship. Hey, here's the deal. Ideally, we've already put together a document package, send it over. yeah, this looks good. We can usually get a commitment out in a day or two, depending on when we get that in. If it's late in the evening on the one day where we're probably not going to receive it that day, maybe the next morning or mid next day. But yeah, it's hard to say. I mean, ideally, there's always some sort of 5 business day condition of financing on there. Because I mean, you don't go into a deal saying, hey, I'm going to get private financing unless right? Unless you're looking for some sort of gutted or distressed property and you're going to convert it or renovate it. But in most cases, people don't necessarily go in looking for, hey, I'm only going to take private. But so I'd still recommend 5 condition days. But on the private side, we can get those flipped around pretty quickly. It's a lot easier for the private guys to put together a commitment because there's no debt servicing. They're not really worried about too much. And they just make the commitment conditional on a few things. So in terms of having that commitment, yeah, within a day or two, max, you should really get something back from the private guys. So that's kind of the turnaround from there. And then, it's just going to be valuing the property. A lot of the independent guys, some may accept a standard appraisal. Some of our independent guys have their own realtor that they send out to do a realtor opinion of value. And the reason they do this is because they put the onus on the realtor to be able to sell the property off for what they valued it at. So if you have a property that's worth $600,000 and you're picking it up for $300,000, it's on that realtor to go out there and say, hey, yeah, this property is actually worth $600,000 in this market. And, if 6 months, 8 months down the road, this guy defaults, yeah, we can get $600,000 for this, no problem. That's going to be on that realtor to go and sell that. So that's why in some situations, we've had borrowers that have came to us, last minute, they already have an appraisal, but our guys want to go out and, do their own evaluation. And that's why. And especially on these creative deals, these investors that have the money or the private lenders that have the money, they've been around. They know there's people out there who have preferred appraisers that they use to get the values and they understand that market and the relationship that's there. So they're not just going to trust any appraisal that comes across their desk, regardless of who you are. Unfortunately, they're going to want to do their own due diligence. It's their money, or, they are an originator who's putting out, a pool of money from a bunch of different investors. So, that's their day job. And if they put their investors into a loan that turns south, no one's going to invest with them anymore, and they're not going to be making that profit. So that's why you see those guys who want to get their own appraisals and their own evaluations done. Yeah,
really appreciate that perspective. And just building upon the idea of private lending here, we've got another question. I keep hearing about a popular private lending option. Once the banks stop offering you mortgages, what's usually the criteria to secure private financing if you secured a solid deal from the start? So let's say, I'm guessing this question's coming from the person that maybe they've got 3, 4, 5 mortgages at an A lender. It's starting to get a little bit more difficult now to get financing. They're thinking about going private. Anything they should be aware of or any changes to their approach?
Yeah. First off, I would say if you're hitting your property limit, buying private and then trying to refinance out isn't really any different than trying to just buy another property. You're still going to have to take that property back into a conventional portfolio. So, I mean, if you have 5 mortgages on the A side and you're trying to buy another one and, they say, no, you have too many, just because you go buy it privately and then try to refinance it back in, that's still 6 mortgages. So they're still going to say no, most likely. What you're really looking at is private financing is going to be great for acquisitions of dilapidated type properties or underperforming assets on the multifamily type side. So if you're looking to buy a property, it's got holes in the roof, it's got mold, it's got water damage, you're going to gut it. Most of the time you're looking at a private acquisition because the private lenders don't care as much about the property per se, more so like what is their equity position in that property. You're going to renovate it, you're going to gut it, perfect. You're probably looking at a private lender. Awesome. Now there are some situations where maybe you are 1 year into your business and you can't quite qualify for a standard conventional mortgage and you just need 1 year to have that second year. Yeah, getting into a 1 year mortgage with a private lender, getting it done with a mortgage investment company, keep the rates competitive, keep the terms good. And then at the end of the year, we can refinance you back out. Now that is an option where that private lending can work. But if it's in regards to like maximizing your portfolio, your better option is to take a look at a B lender who may allow you to get up into that, 7, 8, 9, 10 property limits, or taking a look at the small commercial product that we have where there is no true limit on how many properties you can have.
Awesome. Yeah, I appreciate you breaking that down. And just, I know we talked about it earlier, but for anyone that's maybe joining midstream, a B lender is
A B lender is a Schedule II bank. So there's your Schedule I or your Schedule A banks, which are the Scotias, the First Nationals, the MCAPs, the true AAA prime lenders. And then there's their what we call subprime or B lenders is the Schedule II banks. It's still conventional, regulated, federally regulated financing options. They are just more solutions-based type products. So they have really great business for self products. They work with borrowers who are next day out of or discharged out of like consumer proposals or bankruptcies or lower credit. So if you have a bruised credit score, you're below 650, and you're trying to recover that credit, but you still want to buy a house, we have an option to be able to get you in and then start to work towards improving your credit and then graduate you back onto the A side. And a lot of these A lenders actually have their own B product, which is advantageous because you're working within that same lender throughout the graduation system. So we can start you on their B side, while your credit score is 500 or 550, 580, whatever it is. We get you a couple of credit cards. We start getting them to use them. You pay them off. We get that credit score back up. And then we take you back to their A side, graduate you back up, refinance out in a year or two whenever your credit's back up there, and get you back onto the A side. They work well with increasing property limits as well, too. There are some lenders out there that allow you to have up to 10 on the B side. So that definitely helps. They have higher debt ratios, so you can accumulate a little bit more debt. So business for self guys who use a lot of credit cards and lines of credits, you're going to have high utilization and just higher levels of debt than what a T4 employee may have. So again, if you need that little bit of extra room in your debt servicing, going on to the B side can be advantageous. But B sides aren't private lenders and they aren't commercial or small commercial lenders or credit unions. They are conventional residential lenders.
Awesome. Appreciate the breakdown. And so the next question we got here is there any banks that would loan a sixplex on the residential side? I know RBC is, but wouldn't do it if you're buying in a holdco. Will only do personal purchase. Thanks, guys. And so if the answer is no, are there any other solutions you'd recommend?
Yeah, I know RBC is really the only one that does allow that. RBC pays their own insurance premium. So they don't go to CMHC and ask for it. They pay their own premiums if anything is. So they have a lot more flexibility on some of those 6 units. And I know they're really the only ones, but they can be picky kind of as you're noticing. If you're looking to purchase it on a holding company, we have small commercial lenders that have quite competitive rates that will allow you to buy a 2 unit, a 3 unit, a 4 unit, a 5 unit, a 6 unit, up to a 30 unit in a holding company, and keeping the rates competitive. On the small commercial side, you're looking at 2.4 to maybe 3.5 on that interest rate. And that's because they have a pretty wide range of terms. So they have a 1 to 10 year term. So you could lock in your duplex at 10 years if you really wanted to, or at 7 years. So that would be your next best option if you're looking to get into a sixplex with a holding company.
Awesome. Yeah, really appreciate you breaking that down for us, Ehren.
And it's personal debt servicing too, which RBC is going to take a look at personal debt servicing, that small commercial side. It's a great option. And we've talked about this a lot. And I think it's going to be a pretty popular conversation moving forward. But people looking to leave that 9 to 5 and maybe you have a holding company that got some properties in, you want to start T5ing yourself a small dividend and don't want to worry about personal debt servicing. Small commercial is that key to be able to escape that 9 to 5 job.
Yeah. And there's definitely a lot of people watching this channel hoping to follow that model. So appreciate you breaking it down for us. Going in a slightly different direction. And not sure if this is really your forte, but any creative ways or suggestions for someone looking to finance a property as a Canadian wanting to buy, say, in Florida?
I know there are a few lenders. We don't really. So I guess my answer is we don't really have conventional lenders that will allow us to put mortgages out in the US. I know there are a few banks that will case by case allow you to go into the branch and get that done. Other than that, I mean, we have some private investment companies that are like Can-Am type properties. So, that could be an option privately. But in terms of getting that refinance done, that would kind of be up to you to go back to your bank and find a way to get it done. Unfortunately, we don't have much availability to be able to do financing in the States.
Awesome. Yeah, well, appreciate you sharing that perspective again, Ehren, and really just appreciate you joining us. I know you're calling from the cottage. It's a Friday, so we
Don't
won't take
worry.
up any more of your time. But for anyone that has any other questions, jump into the comment section. We're looking to do probably one live a month with the mortgage guys from Findlay Mortgages. So there'll be a link in the video description down below if you want to reach out to Ehren or his business partner, Josh. And otherwise, just let us know what questions you would like us to cover in future videos. Appreciate you guys watching. Smash the like button, hit subscribe if you're new to my channel, and we'll see you in the next video. Thanks again, Ehren.
Thanks, guys. Thanks, Matt.